This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. To start your investment journey or for wealth management insight, you can look up www.patrickmleonard.com. All Patrick's contact information is right there. It's a great place to start or a great place to make a transition. If you are watching this on YouTube, please subscribe and share as well. Welcome to the Wealth Roundup for the week of July 10th, 2026. I'm Terry Evans and Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Patrick, I was looking at the year-to-date stats on, I guess it's MSN has their S&P TSX Composite Index, and it's snugged up just over 11% year to date. And then I went 1 year, so a year, a calendar year.
Yeah.
And that is impressively 30%. So optimistic times on the markets. Is that what's going on right now?
Yeah, it does matter what day of the week you check those numbers because they do move around a little bit. But I like how you looked out kind of further. The year to date number has been moving around a little bit, but yeah, really strong 1 year number, really strong 2 year number. You really have to kind of go back to 2022, which is the last time we saw a calendar year with a negative rate of return and a significantly negative rate of return at that. So I think most people are looking at their 3-year investment performance numbers and feeling pretty good. Whether or not you're in an all equity portfolio or in a growth portfolio or balanced portfolio with a little bit of bonds, is you're feeling pretty good. What's also good about that is there's likely more to come. I don't think we're done yet. If we kind of think since our last podcast, the S&P 500 is, up a little bit, about 60 basis points. The TSX is up about another 1%. Gold kind of stopped the bleeding a little bit, and is kind of now hanging around, 41.30, which was good. I was kind of wondering whether or not gold would drop below 4,000 US an ounce. Most of my clients own some gold bullion in their portfolio that we acquired back, as early as 2020. And, with the strength of the US dollar, gold had a little less shine on it. Oil prices continue to kind of pull back, even though, we know that the amount of ships passing through the Strait of Hormuz is still far below the traffic levels that we would have seen in, say, February. And actually, Western Canadian Select, that differential right now is sitting at about $12, so kind of narrowed from where we were last week. And, even Bitcoin is getting a little bit of love over the last 5 days. And so some of the bleeding kind of stopped there. So, we're going to go into, start earnings season, looking at the first 2 quarters of the year. So we're going to get into that next week. For the most part, we expect that to be positive.
Recently in the news, I've been seeing chatter and stories and social media posts about Danielle Smith and the Ontario Premier talking about a pipeline. Is that the pipeline that you're referring to and how it's going to affect investors? Is this what we're talking about today?
Yeah, you got to be careful which pipeline we're talking about, because we kind of got like pipelines going everywhere. It's kind of like that old game Mousetrap, where you've got all these different routes of exit to get oil out of landlocked Alberta and get it to market, whether or not it's the West Coast, which might open up more oil getting to Asian markets. Whether or not it's the Prairie Connector, which is a revival of the Keystone pipeline, or this new Northern Shield pipeline, which had Ford out flipping pancakes with Danielle Smith. So seems like everybody has wanted to be down at the Calgary Stampede, finding a way to get a pipeline deal done with Danielle Smith. So I think it's, the timing is really interesting. A year ago, it seemed like the chances of any more pipelines, were few and far between, especially after we saw how the costs of the TMX pipeline had exploded. Thinking, when Kinder Morgan kind of got out of that project and the federal government came in and picked that project up, what it ended up costing to build that pipeline was, I want to say 3 times what it was. And so none of these pipeline projects are cheap either. I think that the expected cost to build the West Coast pipeline, which of those 3 that I just mentioned is probably the one that is the most advanced, is going to be around $38 billion, and they don't even have the route finalized yet. But what it has done is it's kind of percolated, investors thinking, should I get, increase my exposure to pipelines, maybe just increase my exposure to energy in general. As Canadian investors, we're, if we're somewhat following the index, we're going to have a fair amount of exposure to energy anyway. I would just remind investors, I said, this is positive for Canada, but be cautious about, loading up on just this particular news. A lot of these projects are years and years and years away. The funding for how they're going to be paid for is probably not fully complete yet. But what we have seen even just this week is just some targets raised for the pipeline sector. So, believing that these stocks could to move to some higher prices, which I think we would have expected anyway on a higher average price per barrel, which is good. I just really continue to like this news for Canada because it continues to be able to say, we're always looking for what the market is going to deliver to us in the future. So, we get earnings, as I mentioned, and earnings are going to tell us what businesses have done over the first 2 quarters of this year. But in order for stocks to move higher, we need earnings to continue to grow. We need to continue to see economic expansion. So we need to have reasons to continue to get excited about that expansion. And so these type of projects are exactly that. And I think that's very important for us to be able to say, can the market continue to do just like what you've highlighted? Very good year to date. What can take us to the end of 2026?
Last night, I finished watching a Ken Burns documentary on prohibition, and it talked about the Volstead Act and the governments in the United States of America that were going through election and whatnot at that time, and how it affected the stock market with the big crash in that era, and how the repeal of prohibition ended up helping the economy. And it just made me think, there's so many things that touch the economy and touch the markets. And we've got primaries coming up, midterm elections down in the United States. How is that going to affect the markets in general? And how is it going to affect us here in Canada specifically?
Well, it's a stark reminder about how short the election cycles are in the U.S. The Americans are kind of going out there to vote. Every kind of 2 years they're out, making a statement on how they think that their government is taking care of them. The party in power probably going to want to go and polish up that penny to make it a little bit better, and of course the opposition is going to want to throw shade at the party in power to go and highlight where their mistakes are. And so we've done some research. Some of the other firms that I do some work with have done some research, and they've highlighted that going into the midterm elections is that we've seen patterns of higher volatility, and most of that volatility has been negative. And so, I think that really, because you don't know what the outcome of the election is going to be, wouldn't surprise me if you just see some money move off the table, move to the sidelines as you kind of approach those midterms. And then after the midterms are done and, Americans kind of know what the landscape of their government is going to look like, for the next 2 years, then we see fundamentals of the market kind of come back. I think this is happening at a time where there's already some sector rotation at play going on. Is that I think the market is looking to say, what, we've seen a really good run on semiconductors. So those would be the chip making companies like NVIDIA and Broadcom and Micron, AMD and ASML. They've all had a really, really good run. A lot of the information about how many chips they're going to manufacture and then sell is already out there. The market has has priced in how successful those businesses are going to be. And now the market's looking for the next big thing. And so because capital isn't infinite, is that as other businesses start to improve their future outlook, is that we see some capital move. And just like, we were talking a couple of weeks ago with the SpaceX IPO, is that, it didn't surprise us that maybe some money came out of some other places in tech businesses, tech companies, so that investors could participate and buy some shares of SpaceX. We talked about how Anthropic and OpenAI have IPOs that are going to be coming out, later this year. Is that this is, the timing where you have investors getting perhaps a little defensive, putting a little bit of money to the sidelines, some other investment ideas coming out, a broadening in the markets clearly happening, is that we would expect some rotation. And this rotation is just natural for investors to participate. They have to decide, almost like if you've got two kids, which one is your favorite child? Which one are you going to, which one of your kids are you going to sell so that you can go and acquire more, capital in something else? So those are tough decisions. They're also decisions that potentially come with tax. So, if you're going to sell and you're going to take some profits on something, you're going to pay some tax, which creates some stickiness around some of these names that have done really, really well. Is, if I've done really, really well on Microsoft, but all of a sudden we've become a little bit more negative on software because of AI. But if you've done really, really well on Microsoft, you're going to be reluctant to go and sell, or to go and throw the baby out with the bathwater and sell it all. So it might just be some trimming of some of your gains, so that you can participate in another theme that you think is worthwhile, and maybe where there's a little bit more value. I'd point out that in today's market, nothing looks cheap. So, for people that are classic value hunters, is that nothing in this market looks cheap. Certain parts of the market certainly look like they have a little bit more value. Where we look at just where the S&P 500 is trading versus its long-term multiple based on forward-looking earnings, is it looks a little expensive. The TSX looks a little expensive. If we were to look out to maybe emerging markets, is we'd say, well, they look a little bit more affordable. And so maybe there's a little bit more value there if we look at where emerging markets have traded versus their long-term value. Within sectors, the healthcare sector, which we've talked about a couple times on this podcast, is the health sector has been, we have certainly more healthcare publicly traded stocks in the U.S. than we do in Canada. So we look to the U.S. healthcare sector. We say, there looks like there's more value there, and things are improving. And certainly on a year-to-date basis, it's doing better, but nothing looks cheap. So there's no really obvious investment choice to say, if I'm going to lighten up on NVIDIA, or I'm going to lighten up on Microsoft, is that, this particular sector, this particular name looks really cheap, and that's going to be the next big thing. So I think sector rotation is healthy. And I think the one other thing I would go and say is that, we were just kind of talking about where we were on a year-to-date basis. I think we need to look past the midterm elections, and we need to expand our time horizon and say, where do we think the markets are going to be by the end of 2027 as compared to maybe where they're going to be by the end of 2026? Very much like when we all first learned how to drive, our parents taught us, don't look at the nose of the car, look further down the road, and that'll keep you out of the ditch.
That's for sure. And of course, everyone knows your favorite child is the one that provides you with the higher return on investment.
You're right, Terry. Of course you're right.
For wealth management and to start your investment journey, you can find Patrick's contact information at www.patrickmleonard.com. That's the Wealth Roundup for the week of July 10th. Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Thanks, Patrick.
Thanks, Terry. Have a great week.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.